This is Iberian Property Insights, an initiative aimed for those who want to be updated on the Iberian real estate sector. My name is Alexandre Lima. Capital markets in Portugal have been pretty slow in the first half of the year, but all of a sudden retail seems to have revived things with two impressive deals, both of which counted with the advisory of RPE. So it is only fair that today our special guest is Bill Judge, Executive Director at RPE, who is going to tell us if after all retail is going to be the new winning horse.
Thank you very much for inviting me to this podcast. Yes, I think you accurately say that there's been a strong revival in the retail capital markets. Investment volumes, we believe, this year could end up at around €1 billion of retail transactions across all retail sectors in 2024, which would be a significant increase on volumes in 2023, which were around 580 million, and in the preceding 2 to 3 years, an average of around 300 million a year. So yes, there has been a relatively quiet retail investment market since the onset of COVID, but now we're starting to see much more activity return to the market. And there are a number of interesting reasons for that. Firstly, I think what's clear to everybody in the shopping centre industry, but it's also relevant for retail parks and other retail formats, is that sales levels, either tenant performance of the key retailers, is excellent at the moment. We've seen a strong increase in sales performance in lots of retailers' business plans since 2020. Often now we are 20, even 30% up on their sales figures previously. Part of that's the effect of inflation, but it's also affecting a good performance through their businesses in a market where there's relatively limited supply of shopping centres, and therefore these assets are becoming more and more important to those brands. Footfalls are more or less where they were in 2019 prior to COVID, but in some centres we're seeing significant increases where additional asset management may have been done, or in a touristic location where boom in tourism, say in the Algarve and the islands, has had a material effect on footfall numbers, not just sales. So one can say that the performance KPIs are excellent. On the investment side, it's led to an environment where often OCRs, occupancy cost ratios or effort ratios, for shopping centres are as low as they've almost ever been in the last 20 years. So we're looking at an environment where income security offered by low OCRs and growth potential in terms of rents also provide a very positive future. So the KPI side of the market, performance of the industry side of the market is very good. And that is also linked in, obviously, with tenant demand. With very good performance for retailers, a lot of retailers want to expand. And we're seeing, therefore, that both into the shopping centre industry and also into retail parks, we're seeing good demand from primary brands entering the country. So that may be new brands, particularly in, say, retail parks, where you're getting plenty of new involvement from retailers such as Pepco, Action, etc. But also you're seeing a consolidation or a growth of space requirements from the key fashion retailers, such as Inditex and Primark, into the shopping centres and even now into certain retail parks. That often may take the form of fewer stores across the whole country, but is often larger, more attractive stores, fully refurbished stores in the primary asset locations.
So you basically cover the whole spectrum of retail. But do let me say, shopping centers and retail parks, many times they do the big headlines of the news in terms of investment transactions. But funny you mentioned Inditex, because very recently they chose Lisbon to open their second world's largest Zara store. But location in high street retail still plays a key role. Is there any hope for those avenues that are a little bit secondary? How do you see that market?
I think what we're seeing in the high street retail market is we are seeing growth. We are seeing a dynamic market in the primary streets, particularly those streets where there's been, let's say, a strong influx of tourism, whether you're talking about Liberdade down into Rocio, Restauradores, etc., and effectively up in Porto via Catalina. So there's good demand, particularly for those locations from the big brands, Inditex is an example, Primark, etc., for stores where either they don't have representation or they don't have the store size they want. So they're going for some of the emblematic stores. But that is often focusing as much on the touristic market as a domestic market. So it's taking advantage of the boom in tourism. I think the market's a little bit more challenging for more secondary streets because there isn't necessarily the same touristic dynamic. But of course, within city centres, areas often change in terms of their attraction. They become trendy. There is an ebb and flow in terms of high street markets. And so you can often see a sort of an interesting secondary market which could become very favourable. It's not secondary, of course, anymore, but Chiado has become very popular as well with a lot of the key brands. The limitation of on the high street market has been the historic nature of the cities, enabling or making large-scale units quite hard to find. So that's been the limitation on the market in terms of retailers finding exactly the space they want, opening large stores, and going into an investment market which would produce the lot sizes that big international investors would want. Often the lot sizes in high street are too small for the international market. That being said, as well, the high street market has been less active on the investment side, partly because yields for high street retail, that's very much a city centre product, are generally lower. And with what the cost of financing today, even if significantly more available than it was 2-3 years ago, there is yes a yield gap versus where people can buy shopping centres or retail parks today, or even supermarket portfolios, which is also going to be a dynamic market sector in 2024. I mean, if I come on to those other sectors a little bit in terms of how the market is evolving, if we pick retail parks as an example, this is the area where there is the most development in the Portuguese market alongside supermarkets. And the two things link in. Often food stores are the anchors of retail parks, but obviously food stores are also developing on standalone sites. But that's an area where there are far more projects in terms of development than it's a shopping centre world. And obviously high street is a much slower area to evolve in terms of brand new, larger stores. So, I mean, we're seeing a lot of retailer demand in retail parks, which is obviously attracting the eyes of investors who are looking at the sector both from a development perspective as a relatively simple concept to develop, and the end investor in terms of buying what is perceived as quite a secure, value-orientated product with a yield gap versus the cost of debt. So we expect the retail park market to produce some interesting deals this year. At the end of last year, we effectively sold Central Retail Park, which is one of the best retail parks or best known retail parks in the Portuguese market. But we're expecting that sector to also grow in terms of investment transactions. But coming back to your original point, we're expecting a total volume or investment volume from retail transactions this year of somewhere around €1 billion. That will be predominantly shopping centres, or retail parks will have its slice of market, plus supermarket portfolios. The smallest slice will effectively be high street retail transactions. Shopping centres, well, already 2 large transactions have effectively signed or closed. One of the purchase of 3 shopping centres by Castellana Properties, a South African investor coming out of Spain, and the other Lighthouse Properties have recently bought Alegre Montijo on the south side of Lisbon. These are 2 large transactions, but they will be followed up by further transactions that are ongoing in the market at the moment, which leads us to that sort of expected target volume, which could be 50% of volumes of all commercial real estate in 2024. We have to see what other transactions are likely to close in other sectors. But certainly, there is a revival going on of demand. It is a revival we're also seeing in Spain, which is having a very active market in terms of shopping centres and retail parks in 2024. But it is based on some fundamentals. I mentioned them before. It's very strong KPIs in this sector, an increase in investor demand, much more liquidity from banks in terms of financing, something that was challenging 2 to 3 years ago, but now has become much more readily available. And of course, attractive returns, an attractive yield gap versus the cost of debt. Not all sectors have a yield gap versus the cost of debt at the moment, meaning that significant rental growth has to be seen on those asset types to push investors' returns into attractive cash-on-cash return territory.
Very interesting. I have 2 questions linked to what you just said. That is the first one, are you not afraid with a sudden rise of transaction in shopping centers that all of a sudden Portugal runs out of product to sell? Can we see a new cycle beginning where, again, we see no transactions of shopping centers in the future?
I think you make an interesting point. I think the activity of the market at the moment, the confidence being shown from international capital, into the Portuguese market and the Spanish market in terms of shopping centres is attracting a wider investor base. It is bringing more and more investors to the market. It is alerting to people to the attraction of shopping centres, retail parks, supermarket portfolios as an investment category. And a lot of that is based on cash-on-cash return potential out of these assets. But that will increase demand. That will also lead to increased availability of stock in terms of vendors who are willing to sell their shopping centres or retail park assets. But I do recognise the comment you're making. A lot of shopping centre investors are long-term holders, and there is a relatively finite amount of stock in the market. The more of these shopping centres are traded into long-term hands, there is a risk that there will be fewer transactions. But I think we're just at the start, really, of a revival of shopping centre transactions, which will certainly last a few years, because we can see more transactions coming on the horizon, and the market is becoming attractive for capital coming to the market, and that is the stimulant for more and more transactions. And eventually, possibly for additional development, but I think probably that's through the retail park sector mostly, rather than pure shopping centre sector.
And I like also to capitalize on your personal experience. You see Europe as more than just Portugal and Spain. How do you see Iberia, meaning the retail fundamentals of Iberia, comparing to the other European markets? Are we in a good position, average, a little bit below? How do you see it?
Iberia is in a good position. Iberia is in a sweet spot at the moment, both in terms of economic terms. The picture for Iberia is quite positive if one looks across Europe in terms of GDP growth, etc., unemployment levels. This is filtering through to disposable income, sales growth, etc., which is helping the retail sector's KPIs, which is helping the market, of course. At the same time, if you also look at the retail sector, there are various fundamentals in these markets where we have generally edge of town, edge of city centre, shopping centres anchored by large food stores. It is not a department store market. Both the UK, Germany, other countries that have been based on department store anchors for their retail schemes have had significantly more challenges as the department store format becomes less and less in fashion and less as attractive as an anchor for those assets. Also, city centre shopping centres are generally less flexible than schemes which were built on the outside of cities, where it's much easier to add extensions, slightly change the concept of assets. So there is the potential there to add value to sites like additional development, extensions, or redevelopment even in certain situations of those assets, which is much harder in the city centre, unless in the city centres you have a very, very flexible residential strategy, which is what's happening in markets such as the UK. But I think it's kind of important to say we are seeing a revival in the shopping centre market in most European geographies at the moment. But at the same time, Spain and Portugal are in a good position, driven by A, the macro environment, B, tourism really helps, and both the economy but also the sort of dynamics of the market, the availability of financing, but also the retail formats are working very well. Retail parks in the period of 2007 to 2011, some challenges in their first phase iterations, but now they're a much more consolidated format, which is working extremely well and has found its right place in the market, which is leading to more and more retailer demand, a much larger list of tenants into the market and new development.
Allow me to launch you a tricky question, because this is something once an investor told me that was about retail parks. He told me, you see, the thing about this kind of assets is that you are not buying the assets, you are buying the people that are occupying it. Meaning, if you don't have strong tenants, the assets doesn't really worth that much. Is it true? Do you agree with this kind of extreme vision? How do you see it?
I think one needs to read retail or see retail anyway as buying a business in many ways. It is not buying pure real estate in the way that buying offices is pure real estate to be occupied by a particular office tenant. Ultimately, any retail concept, whether it's a shopping centre, retail park, factory outlet, or even high street retail, but high street retail to the least extent, let's say, of these, has to be a functioning business, because the business within it has to sell well. So you have to look at retail as a business. So I definitely believe the value of a retail asset is based on the tenants in it, but more importantly, the performance of those tenants in it. Has that retail asset created an environment through its location, through its concept, through how it's managed, that provides the environment for excellent performance and therefore strong value and increasing value going forward? That's what's key in retail. But this is also an area which is not identical, but also the case in the hospitality sector, in certain parts of the alternative living sectors as well. Fundamentally, it's creating concepts that make an environment very attractive for the best performance of its occupier. So real estate more and more has to be seen as businesses, and effectively the real estate is providing the environment for those businesses to flourish, not just leasing space.
Very interesting description. I think we found our title for the podcast. Retail, a step beyond pure real estate, investing in business. Very, very good. So Bill, just one last question for 2025, going in a little bit of a crystal ball moment. What would you say is going to be the trends or the factors that will affect the most investments, transactions?
In the retail sector, I think 2025, we will see a continuation of 2024's activity in the market, but we'll see more investors in the market. So we'll possibly see more competition around the product that is available.
And when you say more investors, can you specify where are they coming from? It's a European base of investors. You mentioned South Africa also.
It's generally international. Okay. Most of the retail market above a certain lot size is generally international. Now, of course, that is not suggesting that Sonai is a domestic investor. Sonai is effectively both a domestic and an international investor, because fundamentally they're backed by capital from around the world. So it's a range of international investors, but it's widening at the moment. At the moment, we have a particular focus of South African capital and various other international sources. What we have a limited amount of at the moment is German fund investors looking at retail at the moment, certainly at shopping centres. But I think this will increase in the retail park sector, the food store sector, and the high street retail sector if the products of appropriate quality can be found. But frankly, both US capital, European capital, plus the existing South African capital is becoming more and more prevalent in the market. We've moved from an environment where there may have been 2-3 investors bidding on each product up to 5 or 6. So there's been quite a strong increase. A lot of that is Spanish companies coming over the border as well, or Spanish-based investors coming over the border to Portugal to expand, to see the opportunities that exist in the Portuguese market. But there's no real area that investors are not coming from. The Portuguese funds will buy in retail, but generally smaller lot size retail. But fundamentally, it's an increase from across the spectrum of predominantly income-focused investors at the moment. Short-term holders looking for IRR over a relatively short period is more likely into retail park developments, not so much into the shopping centre industry, where these are generally existing assets. And ultimately, they're providing a very interesting income return to investors versus other sectors where yields may be much lower, such as living sector, logistics, etc. Certainly buying standing assets.
Very well. And because I kind of derouted you there, I interrupted you. The factor you would mention the most important for 2025?
I think you are right in so much as saying availability of product will be key to actually how active the market actually. We believe that there will be quite a lot of availability of product, but it's not the macro environment specifically that will define whether 2025 is a very active year in the retail investment sector. Of course, I'm working on the assumption that financing conditions will remain good or possibly even better, and the availability of financing from banks, which are pretty positive at the moment, will remain the case. Because I think what's blatantly clear is that without financing, transactions such as shopping centres, which are generally very large lot sizes, are hard to do for investors. So financing will be a critical element, but there's no reason to presuppose that won't be there attractively for the next
And that financing is mostly coming from traditional banks, from other sources?
Most of the transactions at the moment are being financed by traditional domestic or international banks, whether a consortium or on their own, depending on lot size, retail sector. Ultimately, those are the reasons that it's not requiring significant involvement from alternative finance.
Bill, lovely discussion. I hope you have enjoyed it. Very interesting topics here under debate. This was Iberian Property Insights, powered by Grupo Iberian.